Gary Wagner joins us again this week. Gary, thanks for being back with us.
Great to be here. Great to be here with all the Chart Disc viewers.
Gary, let's start by talking support, and we've broken shorter-term support for gold. The question is, could we be breaking longer-term support? What are you seeing on the charts?
Well, actually, I am genuinely concerned. Of course, the big news this week was the fact that minutes were released from Jackson Hole's most recent Fed meeting, and the sense is that interest rates might be raised sooner than previously expected. And of course, that has really led the dollar to rally, the equities to rally, and put a lot of downside pressure on gold. On a technical basis, which is what I look at, we breached 92 and then we breached 1280 on Thursday's trading. And by breaching that, that was a 61% retracement from when the market had a $200 rally, which began at the beginning of this year, the major rally that we've seen. The next level is 1265. And if that level holds, it says one thing. If it does not hold, though, then we have actually inflicted some longer-term technical damage in gold prices.
Now, Gary, it's pretty safe to say that since the start, you've been pretty bullish on gold. Given the events we've seen this week, especially the positive economic data we've seen come out from the U.S., has this caused you to change your stance here?
Well, it absolutely has caused me to look at a couple of things. And the major thing is that it's very, very difficult to look at a bottom when a bottom's in place because people tend to be the most bearish at the bottom of the market. So what we look for are certain signs. And so, for example, the signs that I had been seeing ever since we hit a double bottom at 1180 was a series of higher highs. So we had 1180, we had 1240, then we had 1280. Now, the fact that the 1280 is breached to me is what is significant, because in order to have an upward trending market, we not only have to have higher lows, but we need to get higher highs, and the market has not been able to produce them. So the facts absolutely have to speak for themselves.
Gary, and before we get to your insert, let's talk silver. We've seen how it's been really decoupling from gold these past few weeks. What are you seeing? Well,
absolutely. Silver has had a life of its own, and right now, the numbers that I have been looking at, again, on a technical basis, is 1935, and a move below there, again, is a real signal that we could be in store for lower pricing. However, with the equities markets moving to new highs, I'm actually surprised we're not seeing more support come into the silver market. And really the shining star has been palladium. That's just been really moving along, and that's had a life of its own to the upside.
And palladium, Gary, hitting a 13-year high this week.
On a day like Thursday, where we had dramatic downside pressure in the precious metals, we couldn't say across the board because palladium continued to trade higher.
Gary, one last question. You mentioned the rally we've been seeing in equities. Do you think a top out is around the corner? Does it concern you?
Well, you know, that's a difficult question to answer. At some point, you're going to see corrections, and we've been seeing corrections all along the way as the market moved to new highs, but we haven't seen really deep corrections in the market. And my sense is, because of the nature of the equities markets, you can have a global transition from a recessionary state to a very active state, and that state can last for a long time. One of the things that we looked at, for example, in last week's insert was really that macro view of gold, in which we saw a 6-year rise and a 3-year decline. These cycles tend to move, the super cycles, in years, not months. So are we going to see a peak? I would imagine if we see it moving over, for example, the 20,000 mark, then we'll probably see it dip back down. But we're not getting really very strong corrections, although there are many people that are actually calling for that scenario to unfold.
Fantastic, Gary. On that note, let's get to your insert. What have you brought us this week?
Well, we're going to have a continuation of last week, and we have to look at some alternative models. And the models that we have to take into account the trading activity we've seen over the last week, in which we've had, 5 consistent declining days in the price of gold. How has that affected it? And most importantly, at what point do we have real long-term damage and any bullish model has got to be really pushed to the side for the reality of what we're looking at. But one caveat with that, it's when everybody gets so extremely bearish that those are typically the points that you'll see the market move in another direction. So there's always two sides to every coin, and it's simply being able to identify which side we're looking at.
All right, Gary, let's get to it.
On our last episode of Chart This, I spoke about the fact that it was my current belief that we were going to possibly enter another bullish phase within the gold market. We looked at a macro view, and the macro view, of course, that we spoke about was the fact that we had roughly a 6-year dramatic rise followed by a correction that took us about 3 years to develop, really terminating, I believe, at this double bottom the second time we hit 1180. Now, although that was only 1 week ago, we've had quite a lot of action within the market over this last week in which we've seen the price of gold drop dramatically and 5 consecutive days of lower pricing. So the question that we need to ask ourselves as technicians is whether or not we have really seen some substantial long-term technical damage in the charts. There's no doubt we have sustained some short-term damage. Specifically, I speak of the fact that we broke through a 61% retracement at 1280 in gold, and that is on this most recent decline over this last week. However, when we take a look at the longer term perspective, notice that even though we have broken through 1280, 76% retracement is still acceptable within the model. When we look at the 61% retracement of this larger move, we get what I like to term a Fibonacci harmonics. A harmonics is when you're using 2 different time cycles and coming up with a band or an area where the price is the same. 76% at 1265, 61% at 1261. I believe that as long as the market can maintain a price point above this area, that we still have the opportunity to see gold prices find support and move higher. But there is one large caveat, and that is the fact that this most recent price decline really negates the potential to see these series of lows that we had consistently moving higher. Now we've broken back below 1280. And as I said last week, seeing higher lows is only half of the equation, because to get these higher lows and to really ascertain that we're in any kind of a bull run, we've got to start getting some higher highs. Both components are absolutely necessary if we're going to see this market move from a bear market to a bull market. This most recent activity has definitely lowered that probability. However, don't count the bulls out yet. There is another thing that I'm noticing in the market. It is that we have a narrowing of range. And that's what happens when you get a series of higher lows, but at the same time, we're getting a series of lower highs. And so when we look at the market within this context, we are developing a compression triangle in which the range continues to tighten. So what information can we glean? Well, the first thing is the fact we did break through 1280, and that negates the short-term model that we were looking at. However, on a longer-term basis, as I said, as long as we maintain really above 1265, we still could be looking at a series of higher lows. However, without the higher highs, you've only got half of the equation. It's what we look for, but we have no confirming aspect unless we break above these various highs. At the same time, as long as we're seeing this consistent patterns of lower highs as well as higher lows, we will at some point over the next couple of months reach the apex of the triangle and witness a dramatic breakout in gold prices once we do. So, am I as bullish about gold prices as I was last week? Well, the obvious answer has to be no. This recent decline in gold prices has absolutely put a damper on that potential. I do believe that we still could see this market find support recoup, and move to approximately 1380 over the next couple of months. That being said, as long as we continue to develop this range, which continues to tighten, the obvious observation is that once it reaches that apex, we will see a dramatic move within the market. Over the last couple of years, it's been my honor to work with Kitco Media and to present our Chart This series. Many of our Chart This viewers are unaware of the fact that I do offer a daily newsletter as well as video-based presentation, and I invite you to go to our website, thegoldforecast.com, and there you'll get a lot of information as well as the ability to view past episodes of the Gold Forecast. So to recap, we have absolutely seen this most recent downside pressure and price decline in gold really put some very short-term technical damage in the charts. However, we are still a ways from long-term damage being evident. And if we continue to see a narrowing of price range, expect some real fireworks in October or November as we approach the apex.
Thanks so much, Gary.
My pleasure as always, and I do want to wish all of the Chart This viewers a great weekend and prosperous investing next week. We'll talk to you real soon.
Yes, happy weekend to all. Thank you for watching Chart This. And don't forget to register for our newsletter, which recaps our top stories of the week. You can do so at the link below. Thanks for watching.